All right, let's jump right into this explainer. Today, we're demystifying what is honestly the ultimate banking risk metric, credit cost. If you really want to understand how the banking industry ticks, you absolutely have to understand this term. We're going to look at it through two wildly different lenses, the eyes of a 5-year-old running a lemonade stand and the sharp perspective of a senior Wall Street equity analyst.
To make this all crystal clear, we're taking a 5-step journey. First up, the core banking loop. Second, when good loans go bad. Third, the safety jar. Fourth, defining credit costs. And finally, its impact on bank profits. So, Section 1. The core banking loop, or how a bank actually makes its money.
At its absolute heart, a bank is really just a giant lemonade stand. Just imagine you're 5 years old, you borrow some money from a friend to buy lemons, you make your lemonade, and then you sell it on credit for a bit more than those lemons cost you. That little bit of extra money you keep, that's your reward. Well, a senior equity analyst calls this exact same setup a spread business. The bank raises funds through deposits at a super low cost, deploys them as loans at a higher yield, and simply captures that difference in the middle. The real mind bender here is how this completely inverts a normal company's books. For a bank, your deposits are actually their liabilities because, well, they owe that money back to you, the friendly depositor. Loans, on the flip side, are their assets because the borrowers owe that money back to the bank.
Moving right along to Section 2, when good loans go bad. This is where we introduce risk into the equation. Let's say you gave out your lemonade to 10 kids on credit, completely expecting them to pay you back tomorrow. 9 of them do, but one kid, let's call him Bunty, takes his lemonade and just vanishes. Days turn into months, and it dawns on you. You are never getting paid for that drink.
In the banking world, that missing kid is called a non-performing asset, or NPA. Specifically, we're talking about a loan where either the principal or the interest has gone completely unpaid for more than 90 days. The second a loan hits that exact 90-day mark, the bank just has to face the music. It stops accruing interest, and it's officially slapped with the bad loan label.
But before a borrower fully disappears into that NPA black hole, analysts rely on an early warning system. These are called special mention accounts, or SMA buckets. Think of this as the worried feeling kid. They haven't totally vanished yet, but they're definitely late. SMA 0 means they're 1 to 30 days late. SMA 1 is 31 to 60 days, and SMA 2 is 61 to 90 days. It's basically the dark storm cloud rolling in right before the rain hits.
Now, analysts don't just look at the total mountain of bad loans. They focus heavily on what's called slippage. This is the speed at which good, reliable customers are suddenly sliding into the bad pile over a given period. A bank might boast a totally clean record today, but if that slippage rate is quietly creeping up, that is a massive, glaring red flag. Which brings us to Section 3, the safety jar and preparing for the inevitable.
Listen, a smart lemonade vendor learns pretty quickly from losing money. Now, every single time you give out a drink on credit, you quietly drop a few coins into a safety jar you keep on the side. When a kid inevitably pulls a fast one and runs off, you don't panic, you just reach right into the jar. A bank does the exact same thing using what they call provisions. Provisions are simply chunks of money set aside directly from the bank's profit to cover those expected, unavoidable loan losses.
So the big question is, how full is that jar? That's your provision coverage ratio, or PCR. It's just measuring the size of your safety jar compared to all the bad loans currently sitting out there in your portfolio. If your PCR is sitting above 80%, it means your jar is incredibly full, and you've got very low future earnings risk from the bad loans you already know about. All right, Section 4, defining credit cost. This is the absolute ultimate measure of lending risk.
This right here is the heartbeat of banking risk management. It's the one single metric that everything else revolves around.
Credit cost is defined as the annual provisioning expense expressed as a percentage of the entire loan book. In plain English, it's effectively the running price tag the bank pays for all the bad lending sitting in its portfolio over a given year.
To drag it right back to our 5-year-old's lemonade stand, credit cost is just looking at how many coins you were forced to stuff into your worry jar this whole year, compared to the total number of drinks you poured out. If you barely had to fill the jar, your kids were trustworthy. But if you were constantly bleeding coins into it, your lending was incredibly risky.
Wall Street analysts absolutely obsess over this metric. A low, stable credit cost screams healthy underwriting, meaning the bank is actually smart about who it's handing cash to. But a sudden spike? That signals rapidly deteriorating asset quality. Analysts ruthlessly model this metric forward because, especially for higher-risk lenders, it's literally the single largest swing factor in a bank's overall profitability.
And that leads us right into Section 5, Impact on Bank Profits, and why this is the major swing factor. To really see the impact, you need to meet PPOP, Pre-Provision Operating Profit. Think of this as the honest, hard-working earning engine of the bank. It's the profit generated entirely from that core lemonade spread business calculated before we ever touch the safety jar or account for any bunnies running away. Now here is where it gets super fascinating. Because provisions come directly out of the profit pool, analysts have to constantly play detective, separating high-quality core growth from totally deceptive growth. A bank might report this massive jump in profit simply because their credit costs happened to fall that year, meaning they needed fewer provisions. But that kind of provision-driven growth, it's incredibly volatile. You literally cannot repeat it once provisions hit zero.
This is exactly why credit cost is the true swing factor in this industry. It holds the power to single-handedly crush a bank's reported net profit if the loan book goes sour, or conversely, to artificially inflate the reported net profit if the bank suddenly decides, hey, we don't need to put quite as many coins in the safety jar this year.
Just think about it. If a bank's core engine, their PPOP, barely grew by, say, 3%, but their reported net profit randomly soared by 20%, you are not looking at some incredible business boom. You are just looking at a provision tailwind. The credit costs dropped. And look, while that looks super nice on paper today, it is absolutely not the sign of a permanently stronger economic engine.
So let's put this all together for the banking ecosystem. A bank gathers cheap money, keeps a really close eye out for wobbly loans on the SMA list, pays the credit cost to fund its provision safety jar, and then finally reveals its true scorecard at the end of the year. The credit cost is just this unavoidable toll bridge standing between the gross revenue of the spread and the actual, real money the bank gets to keep in its pockets. Which brings us to our final takeaway. The next time you're scrolling and see a headline about some major bank reporting record-shattering net profits, I really want you to stop and ask yourself one specific question. Is their lemonade stand actually selling that much more, or are they just hiding behind a temporarily low credit cost? I hope this explainer helps you read those financial scorecards with a whole new level of clarity.